Welcome back. Global markets suffering from a historically bad start to the year. Maria Bartiromo sat down with JPMorgan Chase CEO Jamie Dimon in an exclusive interview and found out why he's optimistic about the world economy in 2016.
It's been the worst beginning of the year for the stock market of any year. What do you think is behind? Why are investors so nervous?
Yeah. So, I'm not as worried as the people are really worried, but, look, if you look at the world, in the United States, the economy is still chugging along. I wish it was going faster, but it's strong. It's very broad-based. Consumers are in good shape. Household formation is going up. Businesses are in good shape. Credit's in good shape. The financial system is very strong. I think it's all China, and that, China had uninterrupted growth for 20 years, 10% like clockwork. And as they go to this kind of this transformation to a market-driven economy, reducing corruption, it's going to be more turbulent. And I think what the world is learning now is that China's going to be not only be slower growth, but more volatility, and it's making people a little nervous.
Why are we so nervous about China? Because for the longest time, China was like the jewel of the world. That's where the growth in the world was? It
was predictable, and it's become less predictable. So if, you have the second largest economy in the world becomes less predictable, that just makes everyone a little skittish.
How do you characterize the U.S. right now? You said things are going well, but there are some people who are expecting a credit contraction this year, particularly as it relates to the auto sector, mortgages. What are you seeing?
Yeah, I hate forecasting the future, but mortgages are pristine. Obviously, if rates go up a little bit, it might change a little bit the refis, the volumes of mortgages. But there are a lot of examples where rates are going up and home sales went up, didn't go down. So it's not just the mortgage alone. Auto credit is very small compared to mortgage. I think mortgage is like $10 trillion, and auto loans are like $1.2 trillion or something like that. Yeah, they've got a little extended, but I don't think it's a systemic risk. And people are buying bigger cars, and the leases are on for longer. And the consumer is in pretty good shape. Is in increasingly good shape. 12 million more working since the Great Recession. I think it's something like 5 million in the last 2 years alone. We see that wages are starting to go up a little bit, and certainly with unemployment coming down, you might see some more competition. And so the consumer's in good shape. Household formation is going up. People moving out of the homes. Homes price is still going up. So we think the consumer is doing okay.
When you look at corporate lending today, are you seeing lending mostly for businesses that want to invest in their business, CapEx, building their businesses, or are you seeing much of the lending going toward M&A?
So that's a big question to answer. So if small business and middle market they're still borrowing, credit is very, very good. They're not doing what you and I would call bull market kind of capital expenditures, but they're still doing capital expenditures. Big companies, it looks like capital expenditures are disappointing. And I think that's disappointing because growth has been slower. Remember, a lot of CEOs, they're going to invest when they have an order book. They're not going to invest just because they feel, bullish or something like that. In fact, they feel bullish when the order book goes up. And obviously a lot of M&A activity. And there's nothing wrong with that. That's just another form of economic activity which could be good. And so I think you'll see companies spend more when they have more reason, the economy gets stronger.
So we're sort of bumping along the bottom.
Well, I think we're growing. We've had moderate growth now for 5 years. I think is a better way to put it. 12 million more people working. I think 143 million people work. And so, while everyone's kind of disappointed it's not 3.5%, it's still not terrible. And, as unemployment comes down, hopefully it'll be shared more widely across America.
So we got the first rate increase at the end of the year, finally, after 9 years. What's the impact of higher interest rates? And do you expect that the Federal Reserve is going to be able to raise rates a couple of times in 2016, given this moderate, slow, however we want to characterize the U.S. economy?
Yeah, so I think there's so much focus on that rate rise, and they raised the rates and didn't actually mean that much. And you have to ask the question, why are they raising rates? And the reason has been because the American economy has strengthened. That is a good thing. So the more the economy strengthens, the more they raise rates, it's a good thing. If they have to raise rates because of stagflation, that would be terrible. If they have to reduce them again because our economy is going back in some kind of recession, that would be terrible. But like I said, the economy seems to be okay. The Fed does forecast 4 rate raises. If you look at their dots, the market has 2. It's probably a pretty huge discrepancy in such a short period of time. No one really knows what's going to happen down the road. So even the Fed keeps us saying data dependent, and of course they have to be data dependent. So I hope they raise rates because I think normalization is a good thing, not a bad thing.